Hi, this is Aman Kapoor from Your Insurance Guy, and I hope you're well. It was my pleasure in sharing some thoughts on life insurance for first time home buyers last week. And I'm going to talk about something very on a similar sort of line of thought. I'm going to talk about life insurance relating to your mortgage. And it actually stems from certain concerns that I've actually, have actually heard, and I've received certain, comments from many people in my being in the course of my being in this business. I've been speaking to many people, and a lot of people have actually mentioned to me that it troubles them sometimes to see that mortgage insurance from a lending organization, from a bank where they take their mortgage from, it needs to be redone. It has to be reacquired each time you tweak your mortgage, in the sense when you renew your mortgage, you have to kind of buy the insurance again. If you move from one house to the other, you need to buy insurance again. If you need to change your mortgage from, say, 5-year term is over and you need to kind of move from one lending on institution to another lending institution, that impacts your you need to buy your mortgage insurance again. So you're continuously reapplying for mortgage insurance, simply because you are changing your lending terms and conditions. So each time you tweak your mortgage contract, the mortgage insurance contract also becomes null and void, and it requires you to change, and in most cases repurchase a mortgage insurance policy which is affiliated to your new mortgage insurance contract. And the important thing to understand is that what is changing each time you're doing this is your age is changing. You bought a house at the age of 30, and now you're renewing your mortgage at the age of 35. When you're doing that, it's a 35-year-old who's buying a brand new mortgage insurance policy. So that premium is going to look very different from what you were paying earlier. If you were to refinance, your mortgage insurance will also be different. And if you are then 37 years old, it's going to be costing different to what it was earlier. If you were to move to another house at the age of 40, now it's a whole different scenario. Why? Because you are now probably taking on a different debt. So that amount might be different. You may have to then reapply for a brand new mortgage insurance at a higher age, and therefore the rates will be different. The terms and conditions could also be different. So what is important to remember here is that when you take on a mortgage from a lending institution and you purchase mortgage insurance from a lending institution, then it becomes the mortgage insurance becomes like an annexure to your mortgage. And that is very important. Why? Because that means each time you change the main contract of your mortgage insurance also drops, and you need to pick up a brand new policy. So you're doing that all the time. But and this is very important, but when you take a brand new life insurance policy from a life insurance company, which has got nothing to do with your mortgage, but you take a life insurance policy which in your mind it is for the debt that you've acquired, then that works independently of your mortgage contract. So it's independent of your mortgage. So you could renew your mortgage, you could port your mortgage, you could move into another home and take on a brand new mortgage. Your life insurance policy will stay unaffected, and it will not be impacted by all that is happening in terms of your policy, your mortgage. So that is very important to remember. And that way, if you've taken a life insurance policy which encompasses a lot of, you're looking into the future. You've been able to kind of factor a lot of things that might change later on in your life. The fact that you may have, your family dynamics might change, your incomes might change, you may move into a different house later on. And if you take a policy which is, looking into a lot of short-term, medium-term, and long-term needs, then in that case, you have purchased a policy that you really don't need to change for a long time, and that policy will then look like an asset in your books, in your mind, and that will then work, and it'll actually be portable, so it will move with wherever you are. And if you make any changes to your mortgage, if you change your home, that goes along and it covers you during all those circumstances. And if your health standards change for some horrible reason, you can be sure of the fact that the old policy that you've taken when you were younger and when you were healthier, that is there for you. At this note, all I'm going to say here is that look at the concept, the process, the project of buying life insurance, not only from the perspective of how much it costs you, but truly from the perspective of what life insurance can do for you. And when you speak to a consultant in that area, you will then understand how a life insurance policy can be of multiple advantages to someone like yourself. And in that case, you will be able to extract the maximum value, the maximum advantage in crafting a life insurance policy that can potentially be customized to match your needs. And that will be great. That's what I do, and I'm very happy and most humbled that I have a lot of people out there who have developed a very good relationship with me, and we discuss this aspect of insurance planning, estate planning, wealth preservation planning very seriously. And I think have been a person of value for them. At this note, all I can say is thank you very much for your time, and I look forward to talking to you soon. Have a great day. Bye-bye.